Standard economic theory dictates that sustained growth is impossible without legally secure private property rights. Without these, investors have no guarantee the state won't simply seize what they create. Yet after 1979, China broke world growth records while operating under a system that offered no formal recognition of private property. These reforms were never intended as a full transition to capitalism. Under the four cardinal principles, leadership explicitly designed the market opening to eliminate poverty, while strictly upholding socialist ideology and the dominance of the Communist Party. Investors deployed billions into a system officially hostile to their presence because systemic corruption acted as an informal surrogate for absent property rights. In this autocratic framework, bribery provided the implicit insurance policy required to risk capital when the law itself wouldn't protect it. Entrepreneurs lived under the constant threat of ideological reversal. A policy shift could prompt the state to seize a business, rendering private investment worthless overnight. This fear produced the Red Hat enterprise. Owners ran businesses privately, but filed paperwork to appear on official ledgers as a village collective. Maintaining this disguise meant paying off state agents. These bribes kept true ownership hidden from the central government's radar. But mere concealment wasn't enough to sustain growth. To truly scale, entrepreneurs needed to give state officials a personal financial stake in their survival. In post-Soviet Russia, the state took the opposite approach: mass privatization and shock therapy. Oligarchs claiming these assets were already wealthy with deep capital buffers, resulting in low risk aversion. Because their wealth was secure, Yeltsin-era corruption took the form of a one-time extractive transfer. The official received a fee, and the business moved on. Early Chinese investors, however, lacked these buffers. They were building from zero in an environment where they were highly vulnerable to state interference. Since these entrepreneurs couldn't absorb the cost of expropriation, they couldn't rely on simple one-time payoffs. They required long-term risk and profit sharing. The Russian model is like a toll collector. They extract a single fee, uninterested if the bridge collapses. In China, the official is a silent partner holding equity in the bridge. Their ongoing income relies entirely on keeping traffic flowing smoothly. This poverty-driven model aligned the financial interests of the communist bureaucrat with the survival of the capitalist firm. This chart shows the risk premium formula, which determines how much return an investor demands to offset political danger. The risk adjustment variable specifically accounts for the threat of state expropriation. A single bribe only protects one firm, which isn't enough to change the risk profile of an entire nation. But as millions of these risk-sharing bribes aggregate, they form a systemic web of vested bureaucratic interests across the country. This network raises the opportunity cost to return to hardline socialist policies, which would ruin officials' finances. This systemic friction reduces baseline expropriation risk. As the risk variable shrinks, required return drops and investment surges. Systemic corruption mathematically de-risked the economy, triggering a massive influx of private capital into China. This surrogate system only works as a second-best solution with a specific measurable limit. This chart plots corporate entertainment expenses against financial return on capital. Returns peak at a corruption intensity of 18,500 yuan, acting as a growth-stoking insurance policy. By 2004, bribe intensity doubled to over 39,000 yuan. The mechanism inverted from a protective shield into an extractive tax. Corruption built the conditions for the miracle, but its exponential growth eventually outpaced the system's capacity to absorb it. President Xi Jinping responded with a massive campaign targeting tigers and flies, systematically dismantling these corrupt networks. While this cleans the bureaucracy, it also removes the only informal insurance policy that once protected private capital. The removal of this shield coincides with a resurgence of hardline ideology and increased state intervention in private businesses. Meanwhile, the rollout of a digital panopticon through AI and surveillance makes establishing new, hidden, silent partnerships nearly impossible. If the state eliminates corruption but refuses to build an independent legal system, technological transparency leaves the private economy without any remaining buffer against the state. The state is now attempting to purify the exact mechanism that allowed its capitalist engine to survive its own ideology.